This podcast is intended for investment professionals only.
Hello, and welcome to the first of two market talks for October. In this week's episode, we'll be asking what's behind the sell-off in US Treasuries, what's driving positive correlations between bonds and equities, and what's behind the ongoing strength of the US labour market. Asking the questions is me, Frances Watson, here in the UK, and in the investment hot seat, Bennett, who joins us from Hong Kong. Ben, amongst this market turmoil in bonds, how are you feeling?
Yeah, it's been crazy, isn't it? So the last few days, we've been on holiday here in Hong Kong on Monday, sort of came back to the office on Tuesday and saw the chaos erupting, and it's carrying on a little bit, isn't it?
What's triggered that? I mean, overnight we had, was it the JOLTS openings from the US? I mean, is that another nail in the bond coffin? What's triggered this particular sell-off?
Yeah, so what we're talking about is bond yields flying high across the world, led by the US, though. So yes, I think job data is one of the things that's been helping yields go up. As you say, yesterday we had some more job data which suggested that labour market's still pretty tight. But we've had some data, we've had data for the last few weeks suggesting that the US is still growing pretty strongly. So I guess investors are thinking perhaps interest rates can remain high for longer. But it's not just that. I mean, that's just one thing. There's all sorts of stuff that we've been talking about. Of course, we've been talking about very loose fiscal policy, which was one of the reasons, wasn't it, behind the Fitch deciding to cut the rating for the US. But fiscal policy has been loose for a while. I guess the first half of this year was incredibly loose. So the US is printing a huge amount of bonds and trying to sell them at the same time. We had some revisions for GDP, which made it look as though perhaps the US was growing a little bit stronger than previously thought. So basically, it's a confluence of factors. But the problem is that sometimes when you get these moves in yields and they start to go up, you have an awful lot of people who are positioned perhaps the wrong way. They decided that they thought yields might go down in the future because there was going to be a recession in the future. I mean, that's one of the things that we've been thinking for a while. And all of a sudden, yields start flying high, and you scramble to try and cover that position and try and sell bonds. Everyone's trying to sell bonds at the same time, and you get these liquidity crunch situations. And we've had this in the past, haven't we? Remember the issues at the beginning of COVID, when there was everyone was trying to sell bonds. That was an awful lot worse than it is right now, to be clear. But it was similar, where everyone was just trying to sell bonds at the same time. Very hard to find someone to just step in front of that steamroll, and ultimately that just starts to gain its own momentum, and it's very, very hard to stop it. So there's a few things that have driven it, but I don't really know what's going to stop it, I guess, is the point.
Yeah, to your point, that some allocators out there are going to be very wrongly positioned at the moment with this new pivot. So I just want to turn now to the positive bond and equity correlations, because we've seen that. We saw at the beginning of the summer. That seems to be still the case. How is that added all to the mix then, Ben?
Yeah, as you say, it's the return of the disastrous 2022 positive bond equity correlation. So remember, in 2022, we saw yields going up, and that squeezed equities and credit, and we started to see every other asset class fall in value. So, of course, bond yields going up means that bond prices are going down. So bonds are falling in value, and that's leading to weaker equity credit markets. So why is that the case? Well, there's a fundamental part of it, which means that borrowing costs are going up, and future borrowing costs are potentially going up as well. So bond yields going up, that means if you're a borrower, you want to issue a corporate bond, or you want to borrow some money to buy a car, it's going to cost you more money, and that's weighing on the economy potentially going forward. And if we're worried about growth going forward, and that usually means equity markets fall, credit markets weaken. But there's also this sort of term crowding out. And I mentioned previously that bond yields are going up partly because the US government is having to print so much money and issue so many bonds in order to attract money to pay for their, I guess, fiscal largesse. And by sort of sucking the money into bonds, offering these very high yields, you're taking money away from somewhere else, aren't you? So it's leading to, I guess, less demand for credit, less demand for equities, or at least credit and equity investors are asking for a higher return in order to stay where they are, as opposed to go into these lovely treasury bonds at much, much higher yields. So yeah, fundamental and also a crowding out. And it just feels like a squeeze at the minute, these higher yields. The other part of it is that because treasury yields are going up, you are seeing more money going into US assets. So you're seeing people buy the dollar. So the dollar price is also going up. And that's another part of the equation of this squeeze. So funding costs are going up, and also the thing that you've often borrowed, which is the dollar, is also going up in value. So it's a double whammy. So it's no wonder really that equity markets and credit markets are weakening a bit.
To your point, they're weakening a bit. They're not weakening a lot.
Yeah, I mean, I focus on bonds an awful lot. That's my background. That's the thing that I look at. And I would say at these sort of squeezy levels of bonds, that how high they've got, I am surprised that equity markets and credit markets haven't been weaker, frankly. Credit, particularly credit. Okay, so equity has started to react a little bit. So maybe I'll give you a couple of numbers here. So since the end of August to the 3rd of October, which is yesterday as we're recording. So 10-year treasury yields are up 71 basis points, so 0.71%. So they're up to about 4.8%. That's the 10-year treasury yields. That's a big move.
Yeah,
and that's been driven by
huge.
real yields. Yeah. The dollar index, or the DXY index over that period, is up 3.3%. So again, that's the double whammy. That's the squeeze. Now the S&P 500 over that period is down 6.2%. So that's a reasonable move, but 6.2% is, to be honest, neither here nor there really for equity markets. That you tend to get that quite a lot. So it's moved, but not a huge amount. Now credit spreads, so investment grade credit for the US, the spreads, which is the excess yield over and above the government bond yield, is wider by 9 basis points, so almost virtually nothing, 0.09%. Now, what I would say is that the total yield for the investment grade spread, so the investment grade index, is up quite a lot because it's been driven up by government bond yields and then a little bit of extra for the spread. So an investment grade investor has suffered, but it's mainly been because of the government bond, not because of the credit that they own, if you see what I mean.
Yeah,
so
no, I do.
Starting to happen, but it's not a big wobble yet. But I am worried going forward. If this continues, then I'd imagine things could get worse for investment grade credit, for high yield credit, for the S&P 500 if bond yields keep going up.
And so with this higher for longer environment then, Ben, you've obviously talked about this as the strategy meeting. What conclusions have you come to?
Well, it's funny that we've sort of been right, but almost for the wrong reasons, which is, yeah, it's better to be lucky than good sometimes.
That's okay.
Yeah, we've been generally cautious about equity markets, credit markets all year, worried about a US recession. But it's almost the opposite that's happened, that the US has managed to avoid a recession. And that's one of the reasons why yields are going up, as well as the fiscal reasons, etc. But the fact that we're not in a recession, yields are going up, and that is weighing on credit and equity markets. So we're starting to see some weakness, and that's then playing out in our positions. Going forward, I spoke before about the fact that high yields could squeeze the real economy. We're actually becoming even more convinced now that we're going to see a downturn in the US if these yield increases persist, because it's just going to lead to weaker economic activity, weaker growth, isn't it? We've been okay. We've been positioned correctly for now, and we're going to probably hold on to that just because we think if there is a recession, if there is a downturn, then there probably is some more weakness to come in equity markets, in credit markets. So yeah, we're holding on for what we've had in the past.
And just last point before we move on to the week ahead, what's left of it, Ben. In terms of bonds and positioning along the curve then, as I understand it, and correct me if we're wrong, there was a lot of crowded trade at the short end because, at one point, you were getting risk-free rate, which is pretty decent, as you say. I mean,
Yeah.
a lot of people going into bonds and getting that risk-free rate. What's happened now that at the longer end, the yields have started to rise as well?
Well, we haven't really seen the moves yet because I think we need to see the dust settle and people reassess exactly what they want to be buying. As you said, the short end of the curve has been pretty attractive because you get very nice government bond yields, and you can potentially get an even higher yield if you buy some credit as well. But yeah, I guess as the dust settles, if the long end keeps going up, then you're going to see more people sucked into buying that longer end, and maybe some of the short end credit could come under pressure. But we'll have to see how it goes. This is actually quite a volatile period. In the next few days, if the liquidity situation comes to a head, we could see the Federal Reserve having to step in, and they'll decide what they want to try and support, whether it's government bonds, whether it's credit. And I think investors will have to react to that. So it's almost impossible to say what's going to happen in the next few weeks. But we'll have to see where the relative value comes out.
Okay, well, let's be a bit more, even more short term now, and look at what's happening on Friday. And of course, we've had these very strong numbers out of the US, job openings increasing, and that usually is a forerunner to what's going to happen for what I call the big announcement on employment, which is the US payrolls this Friday.
Yeah, the monthly payroll report. Yeah, there's going to be a lot of focus on that. If labour conditions remain tight, which everything suggests that they will continue to be tight, we're not seeing a big increase in unemployment, we're not seeing lots of layoffs, are we? Then investors will think that the Federal Reserve is going to have to keep these high interest rates on for a longer period of time. That could put further upward pressure on yields, of course. So yeah, that it is. It's that alongside inflation data from the US, which is the week after. We'll get that. Those are the two big data points of the month. So yeah, those will be important fundamentally. And we'll also have to see what happens with the US government as well. I mean, the House Speaker was ousted overnight.
Lots of drama there.
Yeah, that could have implications for whether or not US fiscal policy will remain as loose as it currently is, or will the government have to come to some agreement with the rebels about reducing the deficit? That's going to have an impact on what people think about bonds as well. And just the price movement, the volatility leading to even more volatility. That's the other point, which I keep saying. It's almost moving away from fundamentals at the minute. It's just that high yields, often things break when yields go up because people have borrowed a lot of money, or they have to repay these yields. You often see things in markets start to wobble when you see such massive moves over short periods of time. So we don't know yet what we have to worry about, but I'm sure there is something to worry about.
We avoided a government shutdown last weekend when it was rumoured to be shut down. We might still get one, right? And markets in the state they're in might just think, ooh, another thing to worry about.
Yeah, exactly. It's piling on at the minute, unfortunately. Yeah, so we avoided the shutdown, but that's one of the reasons why the McCarthy had to leave, because the rebels didn't like the fact that he caved in. And the shutdown has only been avoided for a few weeks, and we'll have to get a longer term solution before long. And yeah, as you say, we're just going to be facing the same issues. And yeah, volatility is not good for credit or equity markets ultimately.
So we've talked a lot about the US in this podcast, but let's just focus elsewhere and in Europe. And German factory orders out, I think, as well at the end of this week. I suppose a lot of people will want to know about exports to China, because that's a big market for them, isn't it?
Europe has been weak than the US all year, and part of it has been, I think you're right, the fact that China the Chinese economy has been very disappointing, and Europe is perhaps more exposed to that. So manufacturing, factory orders, capital goods orders, all that sort of stuff from Germany has been suffering. So yeah, we'll see if that continues. But China's on holiday for Golden Week this week, so we haven't had any data over the last couple of days, but it doesn't look as though China's turning the corner. Particularly, it's still under a lot of pressure, and that's going to be weighing on Europe as well, I think.
We've come to number of the week time. Oh, cheer us up with something, Ben. What's your number for this week and why?
I don't think I possibly can cheer you up, unfortunately. I was going to talk about, I gave you some data about market moves earlier. So I was saving the best for last. I was going to give you minus 37.5%, which is that's the total return loss on holding long US government bonds since the start of 2022. So this is an index that I look at. It's the Bloomberg Long Treasury Index. And that index, since the start of 2022, has given you minus 37.5%. Now, those are the sorts of numbers, aren't they? Like equity market crash numbers, isn't it? Down nearly 40%.
Yeah.
It's amazing that a bond can do that, but that is the size of things that we're talking about right now, and it's just been accelerating in the last few days, and that's why I said before that under these circumstances, when you normally factor in relatively low volatility, just clipping coupons, and then suddenly you lose nearly 40%, that's when things start to break. So yeah, sorry, not cheering you up at all. That's the crunch.
I was going to finish it off by suggesting that listeners tune into the Halloween special, where we talk about all things spooky. But you know what, Ben? I sort of think we've done it.
Well, at least in Halloween,
you
can get some treats, can't you? In Halloween, that's the positive.
Yeah, well, let's look forward to those. In the meantime, Ben, good luck with it all, sussing it all out. Thanks for your time today, and thank you to all our listeners for listening. Thank you.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.